Hong Kong stocks rebound as investors evaluate key economic data from China. We look at the state of the French economy as election campaigns officially begin. And Western governments impose more restrictions on Chinese companies as they accuse Beijing of unfair trade practices. Hello, I'm Taiba Aiden with the latest business and finance news on TRT World. Asia-Pacific markets are mixed on Monday as the region assesses key economic data out of China. China's retail sales climbed 3.7% in May, beating expectations of around 3%. However, industrial output and fixed asset investment missed forecasts, growing by 5.6% and 4% respectively. The Nikkei 225 fell by nearly 2%, mainly due to drops in energy and real estate stocks, while the Topix has declined by over 1% following the Nikkei's trend. South Korea's Kospi and Australia's S&P 200 slipped ahead of the Reserve Bank of Australia's rate decision. Meanwhile, the Hang Seng Index reversed losses, rising 0.71% after the data release. Let's get more on this now with Russ Mould. He's Investment Director at AJ Bell and joins us from London. Good morning to you, Russ. Now, how does the recent economic data, particularly retail sales and industrial output, impact the overall economic outlook for the region?
I think it shows that China still has considerable economic imbalances and challenges to sort out because production is growing faster than consumption. And I'm sure the Chinese authorities would like to try and balance that out. They've tried to, you could argue, export their way out of trouble after the real estate bust, but geopolitical tensions and trade sanctions have made that very difficult. So now perhaps they need to look more towards internal consumption and some degree of stimulus for the local economy.
Right, and the People's Bank of China has kept its medium-term lending rate on hold at 2.5%. What's the current sentiment around that?
Yeah, again, it is possible that some stimulus is coming at some stage, whether it's monetary or fiscal. I guess China, one thing it doesn't have to worry about right now is an inflation problem, so that gives them room for manoeuvre on interest rates. But equally, the renminbi has lost a lot of ground since February, so the Chinese authorities will be conscious of that. We must also always remember the geopolitical angle here, which is I'm sure China would rather show a strong currency to the world rather than a weak one. Great countries don't have weak currencies.
Right, and fixed asset investment was primarily dragged by a steeper drop in real estate investment. Where does China's property sector currently stand?
It's clearly still in a lot of difficulty. I think the year-to-date decline in fixed asset investment is 10%, and real estate is 10%. So we're still suffering, or China is still suffering, a major real estate bust, which again is a challenge for the authorities in terms of keeping to their 5% GDP growth target for this year, particularly if consumption is not as strong as they would like. I think now that places a lot of emphasis on the plenum that is due in July, a policy meeting that was delayed from last year, where reform and modernisation seem to be will apparently be major themes and major topics for policy discussion.